Puneet, we have started.
Okay, yeah. Good morning, everyone. I welcome you to Aster Healthcare Earnings Conference Call for the fourth quarter of FY24. The company declared the Q4 and full year financial results for FY23-24. With this, we have the senior management of Aster Healthcare, namely Ms. Alisha Moopen, Deputy Managing Director, Mr. TJ Wilson, Non-Executive Director, Dr. Nitish Shetty, Chief Executive Officer India, Mr. Amitabh Johri, Chief Financial Officer GCC, Mr. Sunil Kumar, Chief Financial Officer India, and Mr. Hitesh Dadda, Chief of Investor Relations and M&A. I would like to inform everyone about how we will conduct this call. All external attendees will be in listen mode for the duration of the entire call. We will start the call with opening remarks by management, followed by an interactive Q&A session. During the Q&A session, you will have a chance to ask a question by raising your hand by clicking on the raise hand icon in Zoom application at the bottom of your window. We will call out your name, after which your line will be unmuted, and you will be able to ask your question. We request you to please limit your question to 2, but not more than 3 per participant at a time. Certain forward-looking statements may be discussed in this meeting, and such statements are subject to certain risks and uncertainties like government actions, local, political or economic developments, technological risks, and many other factors that could cause actual results to differ materially. Aster Healthcare Limited will not be in any way responsible for any action taken based on such statements and undertakes no obligation to publicly update these forward-looking statements to reflect subsequent events or circumstances. With this, I will ask Ms. Alisha Moopen to start with the opening remarks. Over to you, Ms. Alisha.
Thank you, Puneet. Good morning, everyone, and thank you for joining our Q4 and full year FY24 earnings call. Ladies and gentlemen, I'll be sharing a brief on our India quarterly and full year performance, along with the successful completion of the GCC segregation, before Dr. Nitish talks about the India business performance, including the cluster-wise performance details. I'm really happy to inform that we have finally concluded the segregation of our India and GCC businesses successfully on the 3rd of April 2024, post obtaining all the regulatory approvals and fulfilling the conditions diligently. I want to express my deepest appreciation for ushering in a new era to shape Aster India's future. The segregation has clearly allowed us to tailor our strategies to the distinct growing needs of these geographies, and also positions us to seize the unprecedented growth opportunities in the Indian healthcare market. I want to appreciate the wealth of expertise which was contributed by our board, our top management team, to make this transaction happen. Their diverse backgrounds and experiences have been invaluable in overcoming the many challenges that we faced during this transaction. Despite its complexities, their collaborative efforts and strategic insights have guided us through and made us stronger and more resilient, paving the way for the successful transaction, demonstrating the exemplary level of governance maintained by our board, especially considering its nature as a related party transaction. The overwhelming support from all the proxy agencies and the strong shareholder approval in the majority of minority resolution were true reflections of how governance was upheld. This speaks volume about the transparency, fairness, and integrity with which this transaction was conducted, reaffirming our commitment to the highest levels and standards of corporate governance. Looking ahead, the prospects for Aster India remains truly promising. We are focused on growth through brownfield and greenfield projects, aiming to add 1,700 beds within the next 3 years. We also acknowledge the trust and long-term investment that our shareholders have made with us, with a significant portion of the proceeds from the transaction paid as dividends. This entire transaction has resulted in a substantial inflow of cash proceeds amounting to $907.6 million. I'm delighted to mention that we have distributed approximately 80% of the receipts from the sale of the GCC business as a special dividend of 118 rupees per share, underscoring our strong cash position. The remaining 20% of the proceeds have been earmarked for strategic initiatives, particularly in organic growth opportunities. This will enable us to explore and capitalize on acquisitions and partnerships that can enhance our service offerings and expand our market footprint. Now, coming to the overall India long-term performance, over the last 5 years, our India operations have experienced significant growth with a CAGR of 23% in revenue and 38% in operating EBITDA to up to 2024. This growth has been driven by a significant capacity expansion, ARPO growth, increasing international revenue, as well as advanced quaternary and tertiary healthcare services. Our India revenue experienced significant growth during the year with a 24% year-on-year growth, surging to 3,699 crores, supported by addition of bed capacity of 550 beds in the last year, and year-on-year growth of 10% in ARPO, which is now reaching to 40,100 rupees in FY24. Our revenue from international business has also shown a remarkable growth of 44% year-on-year growth to 188 crores, vis-a-vis 131 crores in FY23. Now, coming to the EBITDA, our India operating EBITDA exhibited strong growth, increasing 30% year-on-year, reaching 620 crores in FY24. Overall, India operating EBITDA margin has increased to 16.8% in FY24 as compared to 16% last year. This has been mainly aided by cost efficiencies, operational leverage, as well as EBITDA break-even in our lab business. As a result, overall ROCE from the India business recorded at 16.4% in FY24, vis-a-vis 13.4% in FY23. Our core hospital business has delivered an EBITDA margin of 19.5% in FY24, vis-a-vis 18.9% last year. In fact, our mature hospital, which are the hospitals with more than 6 years of vintage, it contributes to 77% to our hospital segment revenue, and it's delivered a 22.4% EBITDA margin FY24, with an impressive growth in ROCE standing at 32% in FY24 versus a 24.7% in FY23. Our deliberate efforts to establish a sustainable model is clearly demonstrated in our well-diversified specialty revenue mix, with actually no single specialty accounting for more than 15% of the total hospital revenue in FY24. Now, coming to our new businesses of both labs and pharmacy, they've grown at a faster rate of 32% year-on-year at 286 crores in FY24, now contributing to approximately 8% of the total revenue. The lab businesses have demonstrated EBITDA break-even in Q4 FY24. The India profit before tax has increased 34% year-on-year to 281 crores in FY24, and India PAT has increased 28% year-on-year to 188 crores in FY24. Our Q4 FY24 PAT was impacted by a one-off item, which Sunil will be explaining in more detail. Adjusting to that one-off item, our PAT has actually grown by 84% year-on-year in Q4 FY24. Our balance sheet, it remains strong, with a net debt to EBITDA pre-Ind AS reducing to 1.1 times as of 31st March versus the 1.3 times as on 31st March FY23. Coming over to our CapEx investments, we've added 550 beds during the year, which includes 286 beds in Whitefield, Bangalore. I'm really excited to share about our success at the Whitefield Hospital, which actually achieved the EBITDA break-even in just 3 months at ARPOB of 70,000 plus for Q4 FY24. At the outset of our expansion plan, we're on track to increase our bed capacity through a prudent mix of both brownfield as well as greenfield projects, which will result in our Aster MedCity and Aster CMI hospitals expanding to 900 plus beds and 850 beds, respectively. Both our greenfield projects in Trivandrum and Kasaragod are progressing well, and we're also exploring the opportunities to expand into nearby states such as Maharashtra and Tamil Nadu, as well as North Indian geographies such as UP. This expansion will not only increase our capacity and footprint, but also enhance our offerings in specialized medical care with best clinical outcome. We're really happy to be able to receive some very prestigious awards in the last financial year. Our commitment to outstanding healthcare delivery was recognized at the Financial Express Healthcare Awards 2024 where we were honored as the best hospital chain of the year and also conferred of the title of the hospital chain of the year at the Economic Times Healthcare Awards. Additionally, our multiple hospitals such as Aster MedCity, Aster CMI were ranked amongst the top multi-speciality hospitals across India by Economic Times, Times of India, Outlook, and The Week. We've also been awarded for excellence in CSR by the Economic Times. I just want to conclude by sincerely thanking you all for your trust that you've shown in our strategy of segregating our businesses. Identifying the significant demand-supply gap in India's healthcare sector reinforces the confidence in our approach. We're truly excited about our journey ahead as a pure-play India entity with a much sharper focus and remain, of course, to providing not only value, but also sustained growth in the coming years with a leadership team in place. Your confidence, it motivates us, and we are eagerly anticipating to exceed your expectations and achieving shared success. Our expansion initiatives for India are robust, and we will surely deliver strong performance and help to generate value for our shareholders. I will now request our CEO, Dr. Nitish Shetty, to elaborate more on India's performance, including segmental and cluster-wide performance. Thank you all very much. Over to you, Dr. Nitish.
Thanks, Alisha. A very good morning, and thank you all for joining our Q4 financial year 2024 earnings call. The Union Ministry of Health has increased its budget to $11.3 billion for the financial year 2023-2024, representing a notable 13% increase from the previous year. This move underscores the government's commitment to improving healthcare services in India. With this in mind, we are fully dedicated to expanding our healthcare services and continuously strive to harness this potential. Moving to the updates on the India business performance for the full year of financial year of 2024. Alisha has covered most of the aspects, but I'll add a few more important points here. Our continuous efforts pertaining to capacity expansion of 550 beds over the last 1 year have supported in 24% year-on-year revenue growth and 30% operating EBITDA growth of overall India business in the financial year 2024. Coming to the core hospital business performance, our core India hospital business, including the clinics, grew by 23%, showed an impressive revenue of rupees 3,519 crores for the financial year 2024. The effective implementation of cost optimization and operational leverage has resulted in a notable growth of 28% in the core hospital operating EBITDA, delivering operating EBITDA margins of 19.5% in the financial year 2024. Excluding our O&M model hospitals, our core India hospital business grew by 20%, reaching to a revenue of 3,395 crore in the financial year 2024. The effective implementation of cost optimization and operational leverage has resulted in notable growth of 25% in core hospital operating EBITDA, excluding O&M models, delivering operating EBITDA margins of 20.3% in the financial year 2024. Coming to our new business performance, the revenue from labs and pharmacy business grew by 28% and 36% respectively in the financial year 2024, with lab business achieving EBITDA break-even in Q4 of financial year 2024. Insurance payer mix. This is a very important aspect where we have seen the overall payer mix has changed in the financial year 2024, with the insurance patients have increased by 120 basis points and year-on-year to growth of 27 to 27.3% compared to the previous year. And international patients has also grown by 5.4%, improved by 76 basis points year-on-year, offset by cash and scheme patients. Coming to a cluster-wise performance, our Karnataka and Maharashtra cluster performed diligently and with the contribution of 31% in overall hospital business revenue. The revenue of the cluster grew by 35% year-on-year, and operating EBITDA grew by 44% for the financial year 2024, with a strong start of Whitefield Hospital at Bangalore location. I'm very pleased to share that our Whitefield Hospital at Bangalore has achieved EBITDA break-even within 3 months in the Q4 of financial year 2024, giving us a confidence to create similar successful model in upcoming geographies. While reflecting further upon the Whitefield Hospital project, Its success is attributed to strategic decisions such as focusing on underserved specialties like oncology, creating a standalone mother and child hospital adjacent to a multi-specialty hospital, attracting top talent by offering a comprehensive range of services, and addressing the demand for single rooms. The hospital design and the service offerings cater to the current and future needs of the patient and healthcare professionals, contributing to its rapid growth and success. Kerala cluster continues to contribute 57% in the overall hospital business revenue, showed a decent performance, including revenue growth of 19% year on year and EBITDA growth of 21% year on year in the financial year 2024, aided by the sustained high occupancy levels and price growth. ARPOB of Kerala cluster witnessed a growth of 10% year on year at rupees 39,800 in the Q4 of financial year 2024, which is a reflection of price hike, changes in specialty mix, and reduction of scheme work. Andhra and Telangana cluster performance remains steady with the revenue increased by 20% and EBITDA grew by 29% year on year basis in the financial year 2024. Coming to the clinical performance, we are very proud to mention that we have significantly grown on the clinical side, providing cutting-edge medical treatments and performing 100 plus transplants in the financial year 2024 versus 430 transplants in financial year 2023. More than 1,140 robotic surgeries in financial year 2024 versus 480 plus robotic surgeries in financial year 2023, and many more areas of achievement in the clinical space. Coming to the capex, with more than 10% of our current bed capacity added in financial year 2024, we are now reached to a 4,867 bed capacity as of today. To capitalize the opportunities of India's large population and low hospital bed density, we are making substantial capital investment, aiming to increase the total bed strength capacity to 6,500 by the financial year 2027, with plans to add approximately 1,700 beds in next 3 years. As we enter the financial year 2025, we are confident that our increased focus on India will bring positive results. We look forward to sharing updates on our progress in the coming quarters. I now request our CFO, Mr. Sunil, to elaborate more on our financial performance. Thank you very much.
Thank you, Doctor. Good morning, everyone. For the quarter ended 31st March 24, revenues have increased to rupees 978 crores, up by 22% from 804 crores in Q4 FY23. And operating EBITDA has increased to 167 crores with a margin of 17.1% compared to rupees 135 crores in Q4 FY23. With the growth of 24%. Adjusted PAT post NCA for Q4 FY24 is at rupees 87 crores compared to rupees 48 crores in Q4 FY23 with a growth of 84% year on year. For the year ended 31st March 24, India revenues have increased to 3,699 crores, up by 24% from 2,983 crores in FY23, and operating EBITDA has increased to 620 crores with a margin of 16.8% compared to 477 crores in FY23 with a growth of 30%. Adjusted PAT post NCI for FY24 is at 240 crores compared to 147 crores in FY23 with a growth of 63% year on year. Adjusted PAT for Q4 and FY24 excludes recognition of one-time net deferred tax liability of 52.5 crores, which is a non-cash item arising out of transition to the new tax regime following the segregation of our GCC business. ARPOB for FY24 has seen an overall growth of 10%, rising from 36,500 to 40,100. Excluding our O&M hospitals, O&M asset-light hospitals, the ARPOB increased by 14% from 37,000 to 42,100. This growth has been achieved through revenue assurance, price increase, and improved case mix. In terms of cost optimization, our material cost percentage, excluding wholesale pharmacy, has steadily declined over a period of time, which was 25.3 in FY22 to 23.5 in FY23 and further reduced to 22% in FY24. This reduction reflects our effective cost management, strategic procurement, and operational efficiencies implemented across our business units. In addition, we have continued to maintain positive operating EBITDA for the past 2 consecutive quarters in our O&M asset-light hospitals and achieved EBITDA break-even in our diagnostic segment, Aster Labs, in Q4 FY24. For the year ending 31st March 2024, our capex capital expenditure totaled 392 crores, with approximately 60% spent towards expanding our capacity. Over the next 3 years, we aim to add nearly 1,700 beds, with 60% of these being brownfield expansion to ensure there is no dilution of margins. Optimized cash allocation coupled with margin movement, our ROC has experienced significant growth. ROC surged by 300 basis points year on year, reaching 16.4%. Hospital and clinic segment, excluding O&M asset-light hospitals, ROC rose to 24% from 20.9% in FY23. Matured hospitals saw an impressive increase in ROC by over 700 basis points, reaching 32% in FY24. Aster India net debt stands at rupees 556 crores as on 31st March 24, compared to 510 crores as on 31st March 23, with net debt to EBITDA excluding lease liabilities ratio improving to 1.1x as compared to 2.3x in FY24. On that note, I conclude my remarks. We would be happy to answer any questions that you may have. I now request Puneet to open the question and answer session. Thank you.
Thanks, Sunil. We can now move on to the Q&A session. Before moving on to the Q&A session, I would like to request to all the participants, if you can introduce yourself with your name and the company that you are associated with before asking the question. If you are not associated with any company and you are an individual investor, you can highlight that also. Moving on to the Q&A session. The first question is from Amay. I can unmute you. Yeah, Amay.
Yeah, this is Amay here from JM Financial. Thank you for giving the opportunity, and congrats to management on good set of numbers. So the first question I have regarding the RPOBs, we saw around 14% RPOB growth in the non-O&M hospitals. Is it possible to give some guidance on the price hikes for last year and also outlook for the next year, and how RPOBs are looking like for the next year?
Sunil, do you want to come in?
Thank you, Amay. So as I called out in my speech, right, overall, we've grown at a 10% RPOB growth, and excluding the O&M asset-light, because O&M asset-light hospitals already have a very blended and lower RPOB around 20K. And also we are treating more scheme patients who don't have that ability to do the price increase there. So if you exclude that, we're at a 14% growth. Now, if you look at the historically, we have grown RPOB at something like 9%, right? At least 5-year CAGR, if you look at, it's 9% growth what we have taken. Now, this 14% growth has happened because of the multiple reasons. One is the price increase. Second is the revenue assurance project, which we internally took across, basically trying to ensure that the 19 hospitals what we have today, how can we leverage among these various services which we build, and also with a single service master, and also we address a lot of revenue leakage, right? With that, we are able to address this one. In addition to price increase and revenue assurance, also major thing is related to the case mix also, and also the MBT revenue next term. Because if you look at MBT revenue in the year FY23, we did around 4.6% or so with a 130 odd crore, and that MBT revenue has jumped almost by 40 odd percentage, moving to 188 crores, contributing 5.4% of our top line. These are the major various reasons which is added. Now, but in the future, and also another question was the price increase component, right? Price increase component out of 14% would be around something like 3.5 to 4% is what the price increase component would be. And I think that that is around 3 to 4% is what of the RPOB. We can, in the future also, we can look for the price increase bit of it. And in the future, RPOB growth, because we did, optimization projects in this year, that's where the RPOB growth is a little higher. But going forward, we can look at something between 8 to 9% minimum is what we can think the RPOB growth will be. Thank you.
Sure. And the second question I have is on the Andhra Telangana region, where the year-on-year performance have been on the occupancy side and the RPOB sides have been slightly muted. So if you can address that, thank you.
Doctor, you want to take it?
Yeah, we do accept the fact that the performance in Andhra Telangana was muted. We are presently in a discussion with the promoter there who is running the business for us, Ramesh. So we are in a discussion with them to see where we can do the intervention and improve the performance parameters. We are confident that whatever has happened in last will be reversed. The performance aspects will be reversed in the coming months. and we are confident of the performance getting better in the next quarters. And we are looking at some kind of concrete solution to address the situation. At this moment of time, I can only give the assurance that we are working. We are aware of the fact that the performance parameters are not up there compared to other geographies, but we are taking all measures to ensure that in the quarters that concern will be addressed.
Sure. And also one supplementary questions related to Andhra region, particularly outside Hyderabad. So how has been this space in terms of is because I have seen our pops for most of the companies operating outside Hyderabad are quite low. So is it driven by the fact that as in the case mix is quite inferior, or because of the pricing these RPOPs are on the lower side?
Yeah, Amay, to answer this question, in Andhra, most of the cities are on tier 2 and tier 3 cities. They're smaller towns and cities where, of course, doing a high-end work is always a challenge. But we are seeing that thing is different in Kerala. We are able to demonstrate, we are able to do secondary care and quaternary care work in Kerala and improve the RPOPs. I think something similar needs to be done in other geographies. Right now, the challenge in the Andhra state is in the tier 2, tier 3 cities, most of the hospitals are doing secondary care work and a little bit of tertiary care work. But if you migrate to doing the high-end work, the talent is available, and if you're willing to put up the infrastructure and create an environment, this challenge of low RPOP can be addressed. Now, what is happening is a lot of patients from the Andhra are going out of state for the high-end treatment. So if once we are the operators there are able to stop this flow of patients out of Andhra, the issue about RPOP can be addressed. At the same time, another way of addressing is to encourage the penetration of the private insurance. We have seen a great benefit when you do tertiary care and quaternary care work. The insurance penetration helps in making the high-end work accessible to everybody, especially the insured patients. So one is the insurance penetration, and two is focus on tertiary care and quaternary care will help in increasing the RPOP, especially in the state of Andhra. Telangana is different because most of the business comes from Hyderabad and it's a metro city. It's very easy to do tertiary care and quaternary care work. But in the tier 2, tier 3, I think we should emulate what we have done in Kerala.
Sure. Just last question, if I can squeeze in, if we can provide the gross block number for the year for the India business. Thank you.
So,
Yeah, maybe we will separately communicate that information.
Sure. No problem. Thank you so much.
Thank you, Amay. The next participant who is asking the question is Mr. Sanjay Shah. If you can unmute yourself and ask the question.
Am I audible?
Hello. Yes, sir, you are audible.
Yeah, sorry. Yeah. Congratulations to the team, Aster, and appreciate the deal successfully done. And so my now the thing was we are now focusing on Indian operation. I would like to understand from the management about the trajectory of growth from here, as you rightly pointed out about the capex what we are planning inorganic. We're focusing on ARPU growth. Can you highlight upon which is a small business, but it's still material have an impact on the company, on the hospital as a segment, that is pharmacy and lab? That was my first question. And my second question was, since we are now separated from GCC, but still we have our management over there. So do we in future see any synergies to bring in international patient, because still we have reached 5% of our revenue? Is there any scope of doubling there or maybe more from here in international incoming patient?
So Sunil, why don't you talk about the pharmacies?
Yeah. Sanjay, thanks for the question. See, labs and wholesale pharmacy, what we have today, right, that contributes only to the 8% of the overall revenue for us. And also, you are aware, and we have communicated, previous interactions that this whole labs and pharmacy is not something which we are trying to become a all India chain, so that is not the focus here. The focus has always been into continuity of care. So we have 92% of the business coming from this one, and also more than 3.3 million patients footfalls what we have. So how we thought about, and also we are trying to bring our own digital app in next 6 to 9 months. So the whole idea was that how can we create an ecosystem wherein we are giving the OP services. There is a teleconsultation already. We have the IP related services, and how can that be in the future? The lab and pharmacy also can be inbuilt into this, right? That's exactly the reason why we brought in the labs and pharmacy. And even if you see, in case of labs, we currently have around 232 facilities, wherein we have got out of that 15 satellite labs, which only processes the samples, and balance are all our collection centers, which we call it as a patient experience center. And there already, good thing is that we already broken in Q4, so the cash burn has stopped. And now, and also it has got a combination of the Aster and non-Aster business. And over a period of time in last year, we have already reached the non-Aster business component out of our total revenue to almost 25%, which in FY23 it was only 17 to 18%. That is one of the reasons why we're able to break even. Now, going forward, the idea is that we are present mainly in the states of Karnataka and Kerala, and we are not looking for any reason to add the satellite labs. So that means there is no major capex to be spent. It's all about increasing the footprint through patient collection centers, right? With that, home care adding to that, we should be able to drive good volumes and achieve the higher margins. Coming to pharmacy also, we are only present in Telangana, Karnataka, and Kerala. Overall, our pharmacies are around 215 pharmacies what we are present. And you have seen that, right? We have more or less stabilized the pharmacy growth. We are not adding like, previously till first 2-3 years, we ramped up the growth because you need to have a certain bandwidth or the number of stores to drive the volume and also get the leverage on the procurement also. So that's where we achieved 215. Now the idea is to increase the revenue per day per store and also achieve the break even. The way we achieved the labs break even, we are thinking that at least by FY26 end, we should be able to break even in the pharmacy business also. I hope that answers your question, Sanjay.
Yeah, very helpful, sir. Very helpful. My second question regarding international.
Yeah, so Sanjay, I'll come in on that one. So you're right. I mean, there has been a flow of patients from GCC as one of the regions. Of course, India sees patients from across Africa, from Maldives, Bangladesh, and many other countries. But definitely the arrangement we have with the GCC is that we'll continue to sort of make sure that patients that cannot be served in GCC will be sort of funneled to Aster India. I think there are many services which India will always do in terms of quaternary care, the transplant programs, oncology work, which is nowhere in the horizon for GCC. And we see that the trust in the brand which is there. So we'll continue to funnel those cases to India. Dr. Nitish, anything you want to add?
Yeah. Thanks, Alisha. Presently, out of 5.2% revenue what we generate from MVT, around 40% only is contributed from the GCC. Around 60% is coming from the non-GCC countries, especially from Africa and SAARC countries. And there's a bigger opportunity in the SAARC countries. As we all know, the Maldives, the Bangladesh, Afghanistan, there's a huge potential there, which will continue to drive the MVT business. But at the same time, GCC, like Alisha mentioned, we still have kind of a arm's length understanding with the GCC counterpart to continue further the growth of high-end work, because all our hospitals are equipped to do the tertiary care and quaternary care work, which might take some time for GCC hospitals to enable themselves to the level what we are in India in terms of quaternary care delivery. So if you really look at a mix of a patient, around 60 to 70% of international patients come to India for quaternary care and tertiary care work.
Correct.
50% for general work. So in that sense, we are nicely placed to take our revenue growth in excess of 10% in the coming years, enabled by the inflow of a lot of patients from SAARC countries, and then of course GCC always continues to contribute because we have the common brand name in both GCC and India, which will help. We are confident of leveraging on that.
So, Doctor, are we have any plan to enter Tier 1 cities to bring growth from on the ARPU side?
See, if you really look at our mix, 70% of our business comes from the smaller, not the metros. Tier 1, I assume it is metros, but the Tier 2, Tier 3 are the smaller cities like Kochi, Calicut. And 70% of our business are already coming from there. And through the asset-light model, we have already made plans to enter the tier 3 cities. And we have been successful there. But we are mindful about the operating parameters like ARPOPs and all are not might be to the level of larger cities. So we have been cautious in that space. But as a group, we are known to be functioning out of tier 2, tier 3 cities. That's been our strength. And in fact, we are the only group, I can say confidently, that to a large extent, which delivers tertiary care and quaternary care in tier 3 cities. If you see a hospital in Kolhapur, a hospital in Kottakkal or Kannur, are all enabled to do tertiary care and quaternary care work. And this also presents an extraordinary opportunity to attract the international patients, because the international patients, if you see, the SAARC country patients and African country patients are a little price sensitive. They would like to avail treatment in the of course quality is important for them, but the price is also very important. So their expectation can be met in the tier 2, tier 3 cities like in Kochi, Calicut, where the price difference between the metro and these cities are close to 20% to 30% sometimes for high-end work. So if just it's a matter of having better connectivity to these cities, all the inflow of international patients will happen to tier 2, tier 3 cities. Right now, it will be constrained by the air connectivity. So GCC is different because GCC has a very good air connectivity in Kerala hospitals, Kerala geography. But if that changes and we have better air connectivity across, I think most of the inflow of the international patients will happen to tier 2, tier 3 cities.
So, Doctor, coming back to what I understood, since we are doing really very good, remarkably on treasury and quaternary side, and plus we are bullish on international incoming patient also, and also we gradually increase our presence in tier 2 also. So, don't you think this ARPU growth of around 8%, what you cited, is a bit conservative side?
That's a reality. See, like I said, ARPOB, like Sunil mentioned, it's a virtue of two or three components. One is the price increase, specialty mix, and then also revenue augmentation. There are many factors which play in improving the ARPOB. But we are kind of following the industry standards, and some years last year we exceeded the industry standard. But considering we are majorly present in tier 2, tier 3, we have a headroom to improve that, but we have stuck our projection to the industry standard.
Thank you, sir. Very helpful, and thank you very much. Good luck to you all.
Thanks, Sanjay. The next question is from Pinaki. Pinaki, if you can unmute yourself.
Sir, am I audible, sir?
Yes.
Hello. Yeah. Okay. Good morning to everyone. So actually, I've got a couple of questions. So first, actually, sir, you are looking into expansion to areas like Maharashtra and also UP. So actually, can you explain what kind of expansion will it be? Will it be an outright acquisition, or we will be looking for a strategic partner or an asset-light model?
Can you come in here?
Yeah, sure. Thanks, Dr. Nitish. So hi, Pinaki. We are looking at M&A opportunities, single hospital M&A opportunities, and we are open to exploring multiple models there. It could be acquisition or it could be lease as well. And, we can also look at partnership options there. So we're exploring in these markets. I think we already have a presence in Maharashtra at Kolhapur, and we want to expand our presence further in Maharashtra region. Also, we want to start exploring the UP region as well, as we see that region being very attractive. Given how the demand is growing on that side, and a lot of the patients actually go to Delhi cluster for there. So there is a significant opportunity that we see in that market.
Okay, sir. My next question is actually, so what is your actually the number? How many number of patients were international patients, or in a broader sense? And what is your take on international medical tourism, which is Kerala is now almost is one of the hot destinations. So what is your strategy going forward regarding this?
Okay, we lost you in between there. Can you kind of repeat your question?
Sir, actually, am I audible, sir?
Yeah, you're audible.
Yeah. So actually, I want to know actually of the total number of patients, how many were international, or in a broader sense, what is your take on international medical tourism, where Kerala is now actually a hot destination?
Yeah, Pinaki, I explained earlier also, there's a huge opportunity in terms of international patient traveling to India, the kind of work we do in our hospitals. And I specifically emphasize on the fact that international patients who come to India also look for a quality care at a reasonable pricing, right? In that sense, the large cities are becoming expensive for certain category of international patients, like in Delhi or metro cities. There's a huge price difference. Like I can give an example. We have hospitals in Bangalore and hospitals in Kerala. The hospitals in Kerala, larger hospitals in Kerala do at par clinical work with Bangalore hospitals. There's no difference in terms of the capability. We don't refer, Kerala hospitals don't refer to Bangalore, though Bangalore hospitals are in metro. So in the clinical competence, they're up there. And then the price is also 30% lesser than the metro cities. But GCC connectivity is helping driving patients from GCC to Kerala hospitals. But from the rest of the geography, like Africa and SAARC, we do get a lot of patients from Maldives, but from Bangladesh and other geography, we have a challenge in terms of air connectivity. And also, we don't have embassies in the smaller cities. Everything is there in Delhi or in the large metros. If these two issues, because embassies presence helps in processing the visa, because of all the international patients come visit India, with the average stay is more than 15 days. They need a lot of support from the local embassies. So air connectivity in embassy is the key factor. And if these things are get addressed, there's a huge opportunities in tier 2, tier 3 cities. Patients will avail treatment in tier 2, tier 3 cities, smaller towns, for the price and also quality of work. Since we have presence in both the geographies, we have presence in metro and we have in a tier 2, tier 3, we are very bullish about what is going to happen now and in the future also. And we have a large presence in GCC with the robust brand name, and the GCC flow will only improve, but at the same time, because of the pricing and the quality of work we do, we'll also have a lot of patients to the other geographies, hoping with the conviction, because government is doing a lot of work. Recently, I got a circular from FICCI saying that Air India is trying to connect Bangalore and Hyderabad to various geographies, even to Vietnam and those countries, to the metros now, but eventually they are also going to connect, give the air connectivity to tier 2, tier 3 cities. So there's a huge potential. The biggest constraint I see is the air connectivity. If air connectivity improves, there's a huge potential waiting.
Okay, sir. So that's all from my end, and thanks and all the best for the future.
Thanks, Pinaki. The next question is from Mr. Sumit Gupta. Sumit, can you unmute yourself, please, and ask the question? Sumit, can you unmute yourself? Okay, we'll move on to the next. The next question is from Alankar Garude. Can you please unmute yourself?
Yeah, hi. Thank you for the opportunity. So first question, in the GCC deal valuation, there was a $70 million earnout based on EBITDA achieved by the GCC business in FY24. Can you please let us know the gap between the target EBITDA for this earnout and the actual reported EBITDA by GCC in the fiscal?
Amitabh, do you want to give me?
Thank you. So Alankar, if you go back to the terms that were there for the transaction, it was that there was amount set aside as 70 million of earnout, which was between 130 million of EBITDA to 150 million EBITDA, wherein for every dollar of an EBITDA, there was a 3.5 million of an earnout. As we look through the numbers of GCC, the reported EBITDA, despite all the adjustments which were there in the SPA, for the EBITDA to be computed, we still arrive at a number which is in the range of 127, 128 million, even after all the adjustments. So it's unlikely that we will get into the range where the earnout will get triggered.
Understood. And Amitabh, there was another $30 million based on certain other contingent events. So can you elaborate on those as well?
That's right. So if you look back to the consideration, the initial consideration that was set aside was 903 million, and what we finally paid out was a 907 point something. So that 4.78 million that was there was towards the Vahat EBITDA that was arrived at, basis which the consideration was worked out. The balance that was sitting in that amount was for any other further recoveries. Those recoveries are not yet being made. We are in the process of pursuing those. As and when that happens, we shall let the shareholders know. But as of now, we don't have any further amount to be offered to the shareholders as a part of that 28.
Sure, that's helpful. Thank you. Coming to India, if you look at the secondary mix in AP Telangana, clearly that higher secondary mix in the region is a slight deviation from a relatively much lower secondary mix in Kerala and Karnataka. And we have been present in this cluster for quite some time now. And Nitish sir, you did mention about a lot of performance improvement initiatives and discussions happening. So strategically, I just wanted to understand how are we looking at this business? Are we also open to kind of divesting from this business if some of these performance improvement initiatives do not really play out?
Yeah, Alankar. Yeah, see, like I mentioned in my earlier comments, we are doing everything possible to kind of, we sense a huge opportunity in Andhra. There is an opportunity, but there is a challenge where the management team there is not able to deliver to our expectation compared to other geography. Now we have taken 2 quarters as a way forward to kind of correct those things. We are in a serious engagement with this management there. Like you mentioned, if the worst case scenario, if things are not going to change, we will need to take that extreme steps also. But at this moment of time, we are confident in the next 2 quarters we will be making, because they have been improving. There have been a lot of reasons for the subdued performance in the last 2 years compared to the previous years before COVID. But now we are supporting them in all possible terms. But in next 2 quarters, we don't see any substantial reversal in performance. We are, like you mentioned, like about divesting, we are all open to all kind of measures, but we would like to wait and watch for next 2 quarters.
Understood. And maybe a couple of bookkeeping questions for Sunil sir. Sir, if you look at the cash flow statement for FY24 for India, there is a line item change in other financial assets, loans and other assets, which is pretty high to the tune of almost 1700 crores. And that's pulling down our cash flow from operations significantly. Can you please let us know what exactly is this line item?
Yeah, Alankar. See, this is basically because of the, that the reporting change also has happened, right? Today, when you look at the consolidated financials, we are not usually, because the sale has happened on April 3rd, that is a date taken, and it's a subsequent event after the, book closure of 31st March. We are supposed to show it as not as a continuing operation, but as a discontinued operations, right? That's where in the balance sheet, you will see that on the asset side, we have the complete balance sheet asset of the GCC shown under asset held for sale. And on the liabilities, we are shown as liabilities related to the asset held for sale, right? So with that, what is happening is that the 1,500 plus crores, which we are shown as an investment and a non-current investments in the India balance sheet, that we are able to move into current investments, right? Because of that changes in the continued to discontinued operations, we are able to, that is a line item which is changing. But what we can do is that we can separately relay, more detailed cash flow statement for you for other analysis.
Yeah, that would be helpful, sir. Secondly, if you look at the fixed component of O&M fee, can you quantify that, which is sitting in depreciation as per Ind AS 116?
Yeah, I think we even shared that in the P&L RICO and the Ind AS RICO we had given. Just a minute. Yeah. So, for example, so for FY24 for the full year, in depreciation, whatever the depreciation amount is there, out of that 45 crores is related to the India's depreciation. And in finance cost also, out of the total finance cost, 57 crores is related to the India's 116 finance cost. I hope that answers your question.
Okay, so basically on top of this 45 plus 57, there is that additional impact of the variable component, which is there in our O&M arrangements.
Exactly.
Okay, so essentially for the entire adjustment, we need to add all 3 components.
Well, that's very right. Because see that's what we are explaining in the note. See, usually Ind AS 116 really works only when your future lease rentals are fixed of nature, because that's when you are able to calculate what is your future cash outflow, and you bring a present value, and you reverse that EBIT, rental from the P&L, and you bring back again as a depreciation interest. But if it's a variable amount, Ind AS 116 cannot apply there. That's where that will still be above EBITDA. That's where we have brought the differential between operating and reporting EBITDA.
Understood. And maybe one final question. If you look at the overall reported India EBITDA and the segmental performance, there is a gap which can be explained by all the intercorporate eliminations. So just wanted to understand the nature of these eliminations. So there is 106 crores of intercompany revenue adjustment which is there for this year. I mean, there was a similar 85 crore number for FY23 as well. So,
Right.
I mean, just trying to understand what is the nature out here, and will that number really change with the GCC business going away?
Yeah, see, all the in the note what we put 106 crore, right? The intercompany eliminations, that is related to two particular things. One is on the labs, another is on the EMI, or we call it as a teleradiology, right? So what has happened in the last year is that Aster Labs business, when we talk about last year, we clocked in a revenue of around 118 crores. Out of that, 75% almost near business comes from the Aster business, right? So that's the intercompany. So that is the expense. It's a revenue in the labs business, which is our volume subsidiary, and expense, it's shown as expense in our hospitals, right? Then the next one is the teleradiology, because see, the whole reason why we are able to consolidate the labs and teleradiology is to ensure that we are able to reduce our material cost and the HR cost. That's something which you're able to already getting the benefit. And the balance amount other than the labs is related to the radiology business. Radiology business is sitting, or the consolidated radiology business is sitting in the listed entity. And we are able to give service to all our other subsidiaries within the Kerala and Karnataka and Andhra region. So that is the balance revenue which is sitting there. So we expect that you will not feel the same growth happening, because this labs, because also what will happen also is that because non-Aster business is growing very well in terms of both the radiology and labs business. For example, in FY23, our non-Aster business in labs only contribute around 17-18%. In the FY24, it has increased to 24%. And we see that because hospital growth is in a double digit or a higher teen number, labs will grow at a very higher range, right? The non-Aster business. With that happening, you will not see the growth in the same growth, but the growth will always get limited over a period of time.
Understood, sir. That's helpful. That's all from my side. Thank you and all the best.
Thank you, Lanka. We would like to highlight that we will be giving preference to all attendees who have not asked a question before. So in the line, next question is from Sumit again. Sumit, can you unmute yourself?
Hello.
Okay. Yes, Sumit.
Yeah, hi. Thank you for the opportunity. So just want to understand about the medical value tourism. So in Kerala, so like what is the differential ARPOB which we get through MVT in Kerala versus the normal domestic business?
Yeah. Thank you, Sumit, for the question. See, MVT business usually are approximately 25 to 30% higher than the other cash patients. And there are two reasons why, right, it's higher. It's because all these patients who come in, basically come from single room occupancy, whereas the other cash patients is a blended occupancy of a general ward and twin sharing and single room. That's where it looks higher, or for around 25 to 30%. Second, also this ARPOB which you're talking about, also it doesn't net off the referral fees what we pay. If you do a net off of that, then the nominal increase will be around 10 to 15%.
Understood, sir. So, sir, what's the overall trend that you plan to increase this contribution from MVT from 5% over the, let's say, next 3 to 4 years?
Doctor, you have to add on that?
Yeah, I mentioned earlier, there's a potential to go up to see certain hospitals of ours are already doing 10%. It's a blended, we are getting 5%. So we are confident of in the next 3-4 years to the MVT alone can contribute close to 10% of our revenue.
Okay. So like currently your margin is nearly 17%. So let's say all this MVT also increasing in overall payer mix, optimization of basically payer mix. and your Andhra Telangana margin is subdued, which is I think which is dragging the margins. So do you plan to how do you plan to increase this margin in Andhra Telangana so that overall margin trajectory also reaches more than 20%?
So,
Go ahead. Go ahead.
Sumit, see, Andhra Telangana, if you look at their EBITDA contribution, right, it's almost 5% of your total India contribution. So even if you increase the margin, it is highly unlikely that it's going to move the needle in a very big way. Yes, it can contribute in a in its own way, but it is not going to impact too much, right? But the major is that 95% of the business or the EBITDA is contributed by Karnataka, Kerala, and Maharashtra cluster, and that is what we are looking for the growth to happen. And there, it's very clear that current year, that operating EBITDA will close at 17, and the hospital segment is more than 20, and mature hospitals are 22% plus. We see that, with the continuous ARPOB growth, which is going to happen, which I already guided around 8 to 9%, and also with MVT business increasing and the case mix, because we have been doing a lot of high-end procedures. We did last year, FY24, almost more than 1,000 robotic procedures. We did more than 500 transplants, right? And also we're doing more DBL cases, cochlear implant cases. With all these things going to go more, and with more quaternary care, procedures which we're going to continue to do in next 2 to 3 years, we can see that margins also will expand at a consolidated level near 20% in next 2 to 3 years. And hospital segment alone, we should reach 23-24%.
Okay, understood, sir. That's really helpful. And so second part on the overall CapEx side. So basically out of the overall nearly 1,700 beds planned, how much is greenfield or brownfield?
See, out of 1,700 beds, 60% of it is the brownfield. And greenfield projects are only 2 projects, mainly the Aster Capital project in Trivandrum, which is a 460-odd bed, and another 260 beds from Kasaragod. Right, Kasaragod is expected to operationalize in FY26, and Aster Capital is expected to operationalize sometime in FY27. So our capex requirement for all these 1,700 beds for the next 3 years, that is FY25, 26, and 27, is approximately 1,000 crores.
Understood, sir. And sir, regarding the EBITDA per bed, it's just want to understand why is it subdued versus the peers, and how do you plan to increase this EBITDA per bed, operating bed, basically?
Let me answer the first part of the question, then Dr. Nitish will add on to it. See, already Dr. Nitish also highlighted that, right? We are 70% of business for us comes from the non-metros, right? EBITDA per bed is relative to your ARPOB. We are not in the metros where the ARPOBs are something like 60 or 70K, right? But if you look at our own composition, 70% is from the tier 2 or tier 1 cities where our ARPOBs are around 40 to 50. And you look at our own Bangalore market, we are doing more than 62, 63 ARPOB. But end of the day, India ARPOB, the consolidated level is around 40,100. That is because majority of our business comes from the tier 1 cities, right? I would say non-metros. And considering your ARPOB is at 40,000, naturally your EBITDA per bed will be lower than the peer comparison. But at the same time, we always look for a sustainable margins. And also, because we are in the non-metros, our ARPOB growth, which can come through, is quite high. Even though, see, for example, in metros, already you've seen, right, 40% is only cash, 60% is your credit business. But for us, in the non-metros, we are still at 60-65% still cash business, which we have, right? Only because of the metro, our consolidated cash mixes have come down to 58. With that, we have the potential for growth. As compared to metro cities, their potential of ARPOB growth is always limited. But we are majority being in non-metros, our potential to ARPOB growth is always high. And keeping the trends, what we've done in the historically last 5 years, if we're able to do at least 8-9%, we are very confident that ARPOB growth also will be very healthy in future years. And also along with that, EBITDA per bed also will add to that.
Okay, understood, sir. That's it from my side. Thank you.
Thanks, Sumit. The next participant who is asking question is Damayanti Kerai. Damayanti, can you please unmute yourself and ask the question?
Hi, good afternoon. Am I audible?
Yes, Damayanti, please.
Okay. Hi. Thank you. Thank you for the opportunity. So my first question is on your insurance mix at this point of time, which is around 27%, and you said you have seen good 120 basis point increase compared to last year. And Dr. Nitish mentioned in his remarks that improving this pie would be critical to improve performance in some segments like AP Telangana, which are right now lagging. So just want to understand, how do you see this 27% pie moving up for next few years, and what kind of efforts are taken by your side to really push on this part?
Yeah, thanks. It's a very important question because this is something which is going to redefine the health. It's going to define the healthcare of India. When I talk about insurance, I'm talking about purely about private insurance, because there are others
Yeah.
like government-sponsored insurance. But we spoke about the numbers. What we shared was about the private insurance. Now, in the bigger cities, the private insurance penetration, like in the hospitals in Bangalore, the private insurance work is around 60%, 50 to 60% is covered by private insurance. Whereas when you go to the other geography like tier 2 and 3 cities in Kerala, like larger cities like Kochi, it is around closing to 50% of patients are covered by private insurance. Whereas in North Kerala, the cash patient is more. It is 80% is cash patient, 20% is insurance. So, but this is something which is going to change drastically. At a group level, we have shown more than 1.5% growth, but at a certain unit level, if you really look at it, it might be in the double digits also. The insurance penetration is increasing because this post-COVID, there has been an awareness among the general population, the importance of the health insurance, and also government is giving a lot of initiatives to improve upon the insurance coverage. So the government has come to a conclusion that universal health insurance is a possibility, but universal health coverage is a challenge. So the only way we can address the requirement of comprehensive health coverage is through universal insurance coverage. So as an organization, we are best placed to take advantage of that fact, because the kind of presence we have major presence in tier 2, tier 3, where insurance penetration is going to happen in a big way. And also we have presence in a metro where the insurance penetration has happened to the maximum. And only, I assume that in the future from 60%, the big metros, the insurance coverage will go up to 80%. That is a possibility. Then I also explained the advantage. We don't see it as a challenge. It is only helps in helping the patient to access the highest care and the highest quality of care, as well as the complex work. Now, if Sunil mentioned about how we have doubled the robotic surgery from 400 to 1,000 to close to 1,200 robotic surgeries. This has primarily happened because of the insurance has started covering the robotic surgeries. Same way, oncology is another piece. In our group, we do close to 8 to 10% of oncology work. But I see that might go up to 25% in the coming future. And that is primarily enabled by the insurance penetration, because onco treatment is very complex, very expensive, and long-term treatment is a must. And there are specialized insurance package only available for oncology patients. So a lot is being played out. As an organization, I think we are definitely placed, very well placed to take advantage of the fact that insurance penetration is going to only go up. And that's why we are that much focused on the tertiary and quaternary care delivery, which is a challenge, especially in the tier 2, tier 3 cities to deliver, because acquisition of the talent and creating infrastructure is a big challenge. But we have been fortunate and we have been capable enough to demonstrate that this kind of high-end work can be also done at tier 2, tier 3 cities. I hope I answered it.
Yeah, understood. But it seems like in most cities in, say, Kerala, where you have most of the presence, cash will likely remain the biggest component, and maybe gradually we'll see pick up on the insurance side. But in markets like Bangalore, obviously, I guess it's the fastest growing pie to understand.
The biggest cities, metros, the insurance penetration is happening by a much faster pace compared to tier 2, tier 3. But it's just a matter of time. It is also going to change because insurance penetration is not happening to that extent like in metro, because the high-end work is not happening in tier 2, tier 3 cities. But wherever it is happening, the insurance penetration is improved.
Understood. My second question is on your 0 to 3 years category hospital where you have 6 units. So you can just can you just update us like which hospitals have really achieved cost break even and then moving up further in terms of margin improvement, and which are the units which have slightly longer way before they can turn around at the EBITDA level?
Yeah. Yeah. Thank you, Damayanti, for the question. So the 6 hospitals basically include 4 O&M satellite hospitals. That basically includes our Aster Mother Hospital in Arikod, Aster PMF Hospital in Kollam, Aster G. Madegowda Hospital in Mandya, Aster Naranadri in Tirupati. In addition to these 4, we have got a new facility we added for handling the scheme patients, called as an Aster Ramesh Adiran Hospital in Vijayawada. That's just a 50-bed hospital. In addition to all these small hospitals, the biggest one is the Aster Whitefield Hospital. So when you look at, when you say cash burn, I would say your Naranadri has done really well. We talked about it previously also. It broke even in the first quarter itself. Even today, they are churning out, lower double-digit margins. Similar is the case of Aster PMF Hospital. And our Aster Mother Hospital, Arikod, the losses have really reduced, hardly small losses which is there, and that's where I talked about that Aster O&M hospitals, basically O&M satellite hospital, last 2 quarters at a blended 4 hospitals, we are able to consistently maintain the positive, even though 1 or 2 hospitals are in the loss, but positive margin is there in the all 4 hospitals put together from the last 2 quarters. And Aster Whitefield Hospital also is specifically called out in the speech of DMD and Nitish, wherein we were the fastest break even, right? In 3rd month itself we broke even. So there also losses are hardly any. For example, full year number would be less than 4-5 crores. So that's where you can see 0 to 3 years, even the 6 hospitals contributing 275 crore revenue, the operating EBITDA loss is just 7 crores negative, and that is a very considerable decrease from the previous year. And I hope that is a outlook.
Yep. Thank you. And my last question is clarity. So in terms of margin outlook, did you mention at the console level, 20% is something which you are targeting, and then it will be higher, say 23% or so for the core hospital segment?
That's right.
Okay. Thank you. I'll get back in the queue.
Thanks, Damayanti. So the next question is from Mr. Rajkumar. Mr. Rajkumar, can you please unmute yourself and ask the question?
Yeah, good afternoon. Can you hear me?
Yeah, we can hear you.
Yeah. So I'm looking at slide number 19 of the presentation. This question is for Mr. Sunil. Sir, I just want to know, I saw the note on the tax part that due to the deferred tax liability of 52 crores, the tax looks very high for this quarter. So I just want to know what is the steady state or rather the projected tax rate for the upcoming quarters. So should you work with 25% given that you have now moved to the whatever the normal range?
Yeah, Rajkumar. Yeah, thanks for the question. See, this 52 crores is a one-time non-cash liability, deferred tax liability hit. See, basically what happened is that now we had a major income, right, from the GCC sale, which is upstream from affinity to a listed entity. There is certain higher profit has been generated in the quarter 1. And going forward, we will not be able to continue with our current, old tax regime. We had to move to new tax regime to become more tax efficient. That is the reason why the deferred tax liability has been coming in, right? So and this is a one-time hit. So if you look at the next year onwards, you don't expect that such a hit coming through because already it's a deferred tax liability is already created. So it's a one-time hit for the future benefit, right? Now we are going to see that deferred tax liability only going to unwind over a period of time. Which your next question is that what is the tax which you can take it? So because in the new regime will come down tax to 22% plus the surcharge and cess, you can look at that is only for the profit making entities and also where the subsidiaries where our revenue is more less than 400 crores, we have a lesser rate of 25%, right? But you take a because also we are also making the new assets are coming into picture, new greenfield projects in FY26 and FY27, and also the Whitefield Hospital which we recently started. Even though EBITDA break-even has happened under the PAT, it will have some stress, right? So with all this put together, you can take a effective tax rate on the PBT of something around 14 to 15%.
14 to 15%, right? That's what you mentioned.
That's right.
Okay. Okay. Yeah. Just continuing on this, the same. I have just a couple of more housekeeping questions. The next one is there is a movement of the fair value contingent consideration payable of 6 crores. So just wanted to know, this is just a one-off, right? So this will not again come. the
Yeah,
subsequent?
see, movement in fair value of contingent consideration payable is a non-cash item again, right? See, what happens is that because we have got multiple subsidiaries where we are holding investment, correct? So, and also all these investments, for example, Ramesh hospitals or Prerna hospitals, they do have a certain put option. And when you have a put option and they have a time period, they have the right to put the shares and have the obligation to buy those shares. During that period, as per the accounting norms and the Ind AS, you are supposed to recognize a gross obligation of that liability in the consolidated financial statements. So that is what we recognize when we first take the investment. After that, what happens that every financial year end, you assess or reassess what is the gross obligation based on the future cash flow, or I would say, based on the DCF method. Now, if the performance is really good, that means to say the valuation will go higher. That means to say when they put the shares, my investment will be on a higher side, right? In that case, what happens? The liability goes up, and that any increase or decrease in liability comes through P&L. So 6 crore is basically a decrease in liability because we have seen the Ramesh Hospital performance, right? It's not so great. Because of the liability has come down, and that is where it's getting unwinded as a income, or I would say negative liability at 6 crores.
Okay, got it. And lastly, on this NCA of 9 crores that you have shown, is it coming from your Malabar acquisition?
Yeah, I would say majority would be coming from there. See, we have 3 major subsidiaries, or I would say major mental subsidiaries or MIMS, where we hold 79.6% or so. And the balance we hold is the Prerna Hospital, that is Aster Aadhar Kolhapur. That's where we hold 87%, and the Ramesh Hospitals, where we hold 57.5. And considering all these subsidiaries, major performance is happening in MIMS. One of the very good cash flow. So you can say NCI, whatever 9 crores we have recognized, 80% would be coming from the MIMS Limited itself.
Okay. So just to labor on the same point, so given that you are looking at acquisitions, so would it not make more sense to go 100% on this, wherever the NCAs are happening, because that will immediately give you a 25%, close to 25% upside on your PAT. That's more like a low-hanging fruit for you, right?
Correct. No, your point is very right, Rajkumar. That's exactly what we tried to do in last 1 year. If you know, 1 year back, our stake in MIMS, right, it was at 74%, and we increased almost by 5%. So from the very clear strategy point of view, we are very clear that wherever possible, we'll always increase the stake, and that to such a unit where the performance is quite good. But at the same time, right, we don't have a specific shareholders agreement for them to put on a call option to buy those shares. And also, this is a MIMS Limited where the number of shareholders are very high, but we'll always keep that effort open, but it will always take certain time to get into the 100% or in even near 90%.
Okay. Thank you so much for answering my question. Just last bit on the cost components, I see there's a significant shift between the employee cost and other costs when you look at Q4 FY24 and FY23. So is there anything, significant change in strategy, like the employee cost has come down, whereas the other costs have doubled?
No, it's related to reclassification, Rajkumar. I can give you more insights offline in the bit of it.
Okay, no problem. Yeah. Thanks a lot. Thank you so much for answering.
Thanks, Rajkumar. So the next question is coming from Dr. Binu. Dr. Binu, can you please unmute yourself? Ask the question.
Yeah. Hi. Good morning or good afternoon. Dr. Nitish, just a question on nursing and other technical talent. Nowadays we have seen a lot of corporate hospitals coming up across both yours as well as competitors. Is there any shortage of nursing and other technical talent that you are coming across, and are the costs or the manpower costs in that regard going up?
Yeah, thanks, Binu. Nursing attrition, shortage of nursing is an industry problem. We all are aware of it, and so we have to address this challenge. We have certain inherent advantage and certain strategies we have put in place to address this challenge. Inherent advantages. Most of the hospitals are in Kerala, and majority of the nurses come from Kerala. So we have the distinct advantage of getting the nurses, access to the nurses and paramedical staff. 60% of the paramedical and nursing staffs are from Kerala. So that is, we come from, we are based out of Kerala. That is one fact that it's helpful. But at the same time, we have a cluster approach. When we have a cluster approach, when we are dominant in the micro market, like we are by far the number one in Kerala compared to the competition, it's much easier to retain the clinical talent because everybody wants to associate with the organization which is growing and which is focusing on the high-end work, because the value of the nurse is in getting trained in the high-end work. So since all the hospitals are unable to do high-end work and we have a cluster approach, we are able to retain and train them and cross-train them also. And also we have kind of focus, we accept the fact that nursing is the core of our existence, so that in terms of, you would have seen a nursing award, and we take a lot of initiatives to encourage the nurses not only work as a nurses, but after a certain phase in the career, we also encourage them to take up managerial role, and we also encourage them to get into administration in other areas. So there's a clear-cut path, growth path, but then also we have presence in GCC, which helps in kind of giving a career path them to go to, if they have aspiration to go abroad, they can come join us and grow in India and then go to GCC if required, or if in the GCC, a lot of nurses beyond certain years would like to come back to their hometown. That also, we having presence in GCC in India helps them into kind of closing their career path. So that also is one more aspect. So we do have challenges, but compared to the competition, we have lesser challenges because of the cluster approach and also dominant presence in Kerala, and also the kind of strategies we have taken. We are to a large extent able to mitigate this challenge.
Understood. Actually, my question was more like, in the last 6 months, have you seen anything incrementally on that front?
Not much, but there has been a general, because I don't see a major attrition rate going up compared to the previous years, but it's been consistent. It has not gone down, but it has not gone up also drastically.
Understood. Just from a housekeeping perspective, Sunil, what would be the CapEx number for FY25?
FY25, it could be something like 450.
450 crores. Okay. And just to confirm, when you give this cluster-wise revenue and EBITDA reporting, that also captures the pharmacy and diagnostics revenue and EBITDA of those particular geographies. Is that right?
No. See, when we give cluster, it's very clearly hospitals what we cover, hospital and clinics, but it doesn't include the labs and pharmacies.
Okay, so those are the separately reported numbers.
Yes.
Okay, understood. Thank you.
Thanks, Dr. Venu. So the next question is coming from Mr. Devanshu. Devanshu, can you please unmute yourself and ask the question?
Hey, good afternoon. Can you hear me?
Yeah, we can hear you.
So just 2 questions. Just to follow up on the previous participant. So capex for FY25 is 450. Can you give us a number for the year after as well, projected for FY26?
It is very early, Devanshu, to give it, because this 450 what I given is because we have the budgets and there is a very clarity on what is the project capex. Because see, when we say capex, we've got a project capex of 1,000 crores, which I talked about. Plus it also includes a little bit of a growth for the additional medical equipments we need to do, and also replacement capex, right? So it all includes around 450 crores is what we have. But going forward, usually what we can say is that project capex of anyway 1,000 crores will be allocated in 26 and 27. In addition to that, you can take 1.5 to 2% on the top line as a growth and the replacement capex.
Got it. And just one clarification.
Just to clarify, Sunil, you said project capex will get allocated in 26, 27. I think from 25 to 27, right? The 1,000 crore. That's all for the 3 years.
So, I mean, Nitesh, what I told is that totally we have 1,000 crores to be spent on the project capex for 1,700 beds. Out of that, already given the highlight about 450 crores, which includes the project capex plus the growth and replacement capex.
Sure. Noted. And second clarification I had was on this residual amount of 1,500 crores that we have net of the dividends. What will be the net amount retained by the company post transaction costs and any other costs, if any?
So we basically, out of 907 million, right, 20 million approximately was retained in the affinity level, right, for the transaction cost. Post that, it was upstreamed around 887 million to Indian listed entity in terms of dividend and the redemption of preference shares. That is basically in INR, we're talking about around 7,400 crores. So out of 7,000 crores, 7,400 crores, we already released a special dividend of 118 rupees per share, which amounts to 5,900. That's where you're seeing the balance amount, which is excluding any transaction cost. We have a cash of around 1,500 crores in the listed entity.
So will there be any amount that will be netted off from this?
No, there's no further amount netted off from this.
So this is a net amount retained by Aster India now.
Yes, correct.
Okay, noted. Thank you. That's it from my side.
Thanks, Devanshu. Yeah, I can see the raising hand from Mr. Nitin. Mr. Nitin, can you please unmute yourself and ask the question?
Hello.
Yeah, Mr. Nitin.
Yeah. Thanks for the opportunity.
Can you be please little more louder?
Yeah. Am I audible now?
Yeah. Yes.
So most of my questions have been answered. I have only one question left. So what will be a peak debt post all the capex we are spending for next 3 years?
Nitin, can you come again on the question?
So my question is on the debt, as we are in the capex cycle for next 3 years, what will be a peak debt? So out of that 1,000 crores which we are going to spend in 3 years, can you give the breakup or what will be our internal approval and the debt we are going to borrow?
So let me put it this way. If you keep the 1,500 crores apart, right? Even keeping that apart, we are talking about currently a gross debt of 669 crores, right? So out of that, we have got 1,700 beds to be expanded in next 3 years, which will be again a combination of the debt and internal accruals. And what we are already seeing is that we should hit the peak debt only the FY25. So because that's when the majority of the capex on the greenfield is going to incur in FY25. With that happening from FY26 onwards, you should see the debt per se coming down. That means to say net debt to EBITDA ratio today, what we have around 1.1 may a little bit slightly increase in FY25. And again, after that, it should come down in such a way that by FY27-28, we should go into net cash. Unless we add another, many more beds, which is already in plan. But I'm giving the visibility based on the capex which we have inside.
Anyway, the net debt to EBITDA will remain below 2, right?
Yeah, very much.
Okay. Yeah, that was my only question. Thank you.
Thank you.
Thanks, Nitin. If any of other attendees would like to ask a question, can raise the hand. Okay, I don't see any, raises hands. Okay, so I think there is no more question to the management. Thank you all. Concludes the earnings call of this quarter for Aster DM Healthcare. I thank the management and all the attendees for joining us today. If you have any further queries or questions, please get in touch with us. Thank you.
Thank you.
Thank you.
Bye-bye.
Thank you.
Thank you.